You just hear the name SpaceX or Anthropic and you're like, oh, I would do anything to put some money into those companies. And there are SPV providers who go, great, we're the anything that you want, and we're going to charge insane fees on this.
Today we'll unlock how SPVs went from obscure legal tools to central players in global finance, and why some of the world's fastest growing companies are rethinking them. AJ, you're an investor in SpaceX. Are you a direct investor?
There's actually 6 layers of SPVs that I'm in right now, Sam.
Nice. Early stage SPVs are generally not shady and really cool. Late stage SPVs can be cool, but they can also be pretty shady.
Do you feel like we're in an AI bubble, Peter?
Absolutely. Hands down.
You're a highly educated man. I'll say that about you.
No, I'm trying.
Hey everybody, welcome to Top Line. It's Sam Jacobs. I'm the CEO of Pavilion. I'm joined by my co-host AJ Bruno, the CEO of QuotaPath, and we've got a special guest today. Asad Zaman is not here, but Peter Walker is. He is the Director of Strategic Sales for Carta. He is going to be talking to us about special purpose vehicles, which is the topic of conversation today. We're going to be going deep on SPVs. We're also going to be talking about the state of venture investing more generally and how AI is reshaping what's happening among top and bottom performers in the venture space. Before we get there, of course, we want to check in on everybody, how they're doing. By the way, Peter's real title is Head of Insights. I just try to give him a different
No, it's
title.
Strategic Sales. I didn't even register
Did
that
I get,
when you said
did I get
Sam.
demoted or promoted? I don't know if
I don't
want to
know.
talk
Well,
to
you're
sales
an
guys about
IC now, so your comp is now unlimited. There's no cap commission here on Top Line. As many
Fantastic.
sales as you can make, that's how much money you can earn, my friend.
Put me on that variable plan, Sam. Do it.
AJ, how are you? You're in Montauk?
I'm in Montauk. I'm at my second CEO offsite summit in the Hamptons in a month.
Oh my
Sam.
God. This is for Insight Ventures?
Insight Partners.
Insight Partners.
Partners. They do more than just ventures. Okay, Sam.
Fair enough. I'm sorry.
Yes, this is Insight Partners. They do a CEO summit every year. This is the first time in 5 years that I've been able to actually go. Lucky enough.
Oh, that's
And
awesome. That's
the
great.
selling point was taking a seaplane from New York to.
Oh, you took, because you texted us a bunch of pictures of the plane, but I thought that was your plane. You didn't fly your plane.
Oh no, that's not my plane. No, that was a $3 million Kodiak 200. That was not my plane, Sam. But I really appreciate that you thought that was my plane.
Fair enough. Well, have a great time. Peter, how are you?
Not in Montauk, so I guess worse. Although I don't know. I couldn't read from AJ's tone whether or not he was enjoying himself. So maybe better.
I just landed. I literally landed 10 minutes ago, Peter, and this is my first order of business is to come and speak on Top Line.
That's very kind of you to join us.
That's my actual official title on LinkedIn is co-host of Top Line. That's what I go by.
One place that both AJ and I will be next week is Washington, D.C. AJ, why will you be in Washington, D.C. next week?
I just like to take the train from Philadelphia to D.C. every now and then, Sam. It's a really great train.
Biggest fan over here.
Pavilion is hosting its third annual GTM Summit, GTM 2025. AJ will be there. We're actually going to be announcing the full rollout of Top Line as its own independent media company, of which Peter will be one of the contributors. So you heard it here first. It's going to be awesome. We've also got Henry Schuck, the CEO of ZoomInfo. We've got Josh Barrow and Megan McArdle from Left, Right, and Center talking about the intersection of politics and business. We've got Will Guidara, the author of Unreasonable Hospitality, talking about how to deliver an incredible customer experience.
I think he had a pretty good restaurant too, by the way. I'm pretty sure his restaurant did okay.
11 Madison Park,
it's
baby.
Okay, I guess. Yeah.
The number one restaurant in the world, according to Brandon Barton. So we're going to be there. If you're listening, we hope that you can join us. Use the code SAM30 for 30% off your ticket if you haven't gotten one already. And now let's dive in. Let's talk about SPVs. I'm going to set the stage, and then we're going to hand it over to Peter to help explain further. Special purpose vehicles have become one of the most important financial tools of the past 30 years, designed to isolate risk and create bankruptcy remote entities that protect investors and sponsors. Once mainly associated with securitization, they're now mainstream in venture funding. The market is huge and growing. SPVs are projected to reach $15 billion in 2025, growing at 8% CAGR to $35 billion by 2028. In VC specifically, and this is what we want to focus in on, SPV usage has exploded. Formations are up 116% over the past 5 years, with median SPV size nearly doubling from 1.18 million in 2016 to 2.17 million in 2023. They simplify cap tables, consolidating dozens of investors into one entry, and democratize access, allowing smaller checks to get into elite deals. So there's some strengths, but there's some weaknesses. And recently, Anthropic made a big push to ban SPVs from its $5 billion round at a $170 billion valuation, preferring direct long-term VC relationships and citing transparency, governance, and fee abuse concerns. And that's something we should talk about because that stuff is wild. Today, we'll unlock how SPVs went from obscure legal tools to central players in global finance and why some of the world's fastest growing companies are rethinking them. But let's start at the basics. Peter, what the hell is an SPV and why do they exist?
Sam, that was an amazing executive summary that I feel like you didn't read in normal Sam voice. So
Yeah.
very interesting. Okay.
Sam was like, hey, Enron went bankrupt and was in the news because of SPVs. Peter, please explain yourself.
Right. Yeah. It's like, Peter, what did Arthur Anderson do and why did it fail?
Oh, I love a good
you're
Arthur
up.
Anderson
Yeah.
reference.
No, it was a beautiful handoff there, Sam.
You're a highly educated man. I'll say that about you.
No, I'm trying. Okay, SPVs. So I think this is a really interesting topic because of the Anthropic news, but also bigger companies becoming slightly less excited about this as a trend. At the very beginning, an SPV is a capital structure, an alternative form of fund where multiple investors pool their capital and their goal is to make a single investment. So that's the biggest difference between a fund and an SPV. A fund, you raise money, you probably dole it out to, if you're an early stage fund, call it 20 to 30 separate companies. An SPV is a pooled set of capital that is trying to make one investment into a single company.
And as founders, we typically know this as sidecars. I don't know if that's a term that you use, Peter, on your side, but that's what we hear it as.
So it's sidecars, we hear syndicate, et cetera. There's a couple different ways. The SPV is sort of the legal structure through which these different groups can invest into companies. But AJ, you bring up a good point. There's actually multiple different kinds of SPVs. And I think one of the useful distinctions is to talk about early versus late. So obviously, if you are an SPV into Anthropic, you are not an early stage company that is what are they now? $180 billion? Like ridiculous valuation. The earliest stages, angels will often use SPVs because an angel might say, look, we like this company. We're only going to invest $25,000 in them. That's below the threshold for the company to make it useful. Why don't we pool a bunch of $25,000 checks together and make a real significant investment into this company? So you can use an SPV to affect that sort of financial investment. On the Anthropic side, and often I hear this actually most often with SpaceX, where you hear, oh, we have an SPV into this really hot late stage company. And the reason why Anthropic might get a little bit leery about that is, well, two reasons. One, they want to control who's on their cap table. That's important for the founders of these companies. So within an SPV, it might not be entirely clear to them who is actually a part of this special purpose vehicle because it just shows up as one line item on the cap table. The second point is that oftentimes there's some shady stuff that happens with late stage SPVs. I want to, again, separate these two. Early stage SPVs are generally not shady and really cool. Late stage SPVs can be cool, but they can also be pretty shady where you might have an SPV that's actually invested into another SPV, adding another layer of fees. And then that second SPV is actually invested into the company cap table. And it can be completely opaque to the investors.
Would the SPV in some of these cases, I mean, what type of information rights? Is there like the concern that it's opaque and there's a competitor that's investing in these SPVs to understand the business dynamics more, or is that not really a concern at late stage?
Competitors, I'd say less of a concern. Candidly, the biggest problem with these sort of multi-layered SPVs, so one, information rights might not flow all the way to the end investors. Actually, in most cases, do not flow all the way to the end investors. So it feels like there are people that are kind of taking advantage of how hot some of these companies are. You just hear the name SpaceX or Anthropic and you're like, oh, I would do anything to put some money into those companies. And there are SPV providers who go, great, we're the anything that you want, and we're going to charge insane fees on this. I mean, really, when you think about it, an SPV as in terms of the actual fees and carried interest and all these things that actually happen, you can get a normal SPV has the same 2 and 20 that a fund might have, 2% management fee and then a 20% carried interest. There are SPVs that have more than that. In these hot investments, it might be that the SPV is charging a 3% management fee or even a 4% management fee, and all they're doing is making a single investment and then letting it ride. So is that efficient use of capital? Oftentimes on these late stage SPVs, it's really not.
It feels predatory to your point. And
100%.
AJ, you're an investor in SpaceX. Are you a direct investor or did you do it through an SPV?
There's actually 6 layers of SPVs that I'm in right now, Sam.
Nice.
It's actually funny you mentioned this because I was talking to a friend of mine that's also an investor. I'm like, okay, we have to get secondary somehow. We know who manages the SPV. And when we did it in 2019, I think it was, we looked at the numbers and the carry and the fees seemed reasonable at that time.
Mhm.
And my friend is someone who is very sophisticated with this. So I kind of am trusting him on it. To Peter's point, there are 4 SPVs that are invested in QuotaPath, but they're all alongside the bigger fund.
Yeah.
So, the stage 2, it's actually one of the things that they promote as a plus for their LPs, which are smaller investors. Like, hey, we have this bigger fund, but if you want to like see what it's like, here's a sidecar, here's an investment that you can do specifically around go-to-market tech, which stage 2 has done a lot of in the past. So you have CROs of these bigger companies, of a Gong or whatever, and they can invest in the bigger fund, but maybe they're not as sophisticated, so they can get a taste. It's like an entry point into some of it, is what I've seen.
Yeah.
But they're very popular these days. I mean, the growth of them is insane. So is this like just going to become a SPAC? Is this a SPAC light too coming up?
No, I think SPVs are very different than SPACs in that SPACs are only used for a single purpose, which is to quote unquote take a company public, even though really it's a blank check to then go and buy companies in the public market. SPAC is a very odd financialization mechanism.
I just mean
SPVs,
how they're in trendy right now more than anything
for
versus
sure.
you hear the
I
name a
think
lot.
Doing an entire episode on them, exactly to your point, AJ.
always actually ahead of the trends.
Yeah, AJ's like, hey, we should do an episode
Frontline.
of Top Line on SPVs.
The front line. SPVs are this blanket category, which really just means a vehicle or a partnership that is set up to invest into one company. And so there's 1,000 ways that can happen. Sometimes a lot of VC funds, really reputable VC funds and firms, will use SPVs for various reasons. So maybe they're investing out of fund 3 or 4, and there's a deal that comes up where they just absolutely love the founder, but it's not in the thesis of the fund. So maybe in that case, you set up an SPV, you get a slightly different LP base, and you go in and make an investment into that new company. It could be that the fund is 4 or 5 years old and they're outside their core investment period, but again, they come across an incredible founder. It could be that the fund is out of capital and they need to invest right now into this hot deal and they need an SPV to finance that investment. There's a lot of different reasons why you might use an SPV. The one that keeps coming up in the news is a very specific one, which is SPV as a way to get into the single hottest names in venture. And that is being driven not on the company side, but on the demand side. There are just so many investors from big pension funds down to high net worth individuals who want to put some money in SpaceX or Anthropic or OpenAI. And they're trying to figure out any way they can get access to that name. And in those situations, because the demand is so high, there's often some predatory stuff going on that just doesn't exist when SPVs are used for regular sort of day-to-day activities within core VC funds.
Let's break down the growth of SPVs. So they've grown, 118%. Basically, they've more than doubled over the last couple of years. This is a thing that you could have done at any time in the last 20 years. What do you
Yep.
think the causes of the growth? Is it the AI boom and like this bifurcation potentially of there's a small number of winners and there's not that many of them?
Yep.
What I've heard and I would love your reaction to is if you're not in one of the winners, it's much, much harder. I mean, this is always true. Venture's always been power law, but it really feels like now more than ever, there's a small number of winners. There's a lot of middles and a lot of losers. And so you kind of have to be in the winners if you want to make any money. And the
Yep.
scale, because the funny thing is, whatever valuation AJ invested in at SpaceX, I'm sure he's killing it on that investment.
He's in the money now.
And
That's
I'm
right.
sure, and 170 billion on Anthropic feels like a tremendous number, except for whatever the number will be when they announce a new fundraise in 6 to 9 months.
Yep.
Of course, that begs another question. But do you feel like it's the AI boom that is driving the growth of SPVs, or are there other factors? I'll give you another possible, which is just the prolonged period of private companies not going public, and that we're just continuing to try and innovate to find ways of getting access to and liquidity from these companies that are staying private for longer and longer periods, like
And that
Stripe,
last
Database,
point,
et
Sam,
cetera.
is the point that we need to make, because secondaries are like a lot of these bigger organizations, a lot of investors and employees are looking at secondaries as the opportunity to make capital, which is just so foreign and strange to me.
It's a wild mix of everything you mentioned, Sam. I'll start first on the sort of underlying dynamics, which is it's just gotten easier to create, manage, close SPVs. Some of that's through companies like Carta or others that are actively making this tech a lot more simple. Some of it is a cultural thing where it's now totally fine to have SPVs, even multiple SPVs on the cap table, whereas, 10 years ago, it may have been looked at a little bit differently between core investors. So all of that is certainly happening. On the liquidity side, I think that is probably the biggest shift, is that there are certain funds for whom this investment, though exciting, is not as exciting as DPI back to their investors today. So they're willing to sell out some portion of that investment to an SPV and return a little bit of capital to their current LPs. That's happening a lot. The secondary sort of wave that's happening amongst.
That makes tremendous sense to
It
me.
does. Totally. I think it actually is a missing piece within the venture capital
That
ecosystem
feels
of.
healthy because I'm an LP in a few funds, and then and just like looking at like becoming more familiar with the timescale of venture investments. We talk about this on Top Line a lot. AJ's commented on it as it relates to still seeing nothing from SeatGeeks, despite the fact that it's supposed to have gone public 52 different times. But you look at
Sorry, AJ.
No, it's all right. It's next month. They've announced it. They're good.
oh really?
Oh, crushing it. Yeah, it's going to happen.
Is that true?
No, I don't know.
Uh,
My favorite was right before COVID. Billy Bean from the fame from Moneyball.
Moneyball, yeah.
He started a SPAC and was going to take SeatGeek public and announced it like really. And I was like, oh, this is awesome. And that was like 5 announcements ago of them going public. So here we are 5 years later. Anyway.
I'm looking at like tables. I've looked at 2 different tables from 2 different funds that I'm an LP in, where it's like, what's the typical DPI on a fund of a 4 or 5 year vintage? 0.0.
Yep.
Like,
That's
we're
our
top
data probably,
quartile.
but yes, it's true. You heard it here first. If you're returning capital in the first 3 years of the venture fund, either something went unbelievably right or more likely something went wrong.
Yeah.
Which is because it means one of your investments closed down and you just got money back. And then you didn't choose to recycle it into new bets, which is odd in the first, call it 3 to 4 years, because usually you just recycle that capital into a new investment.
When should you expect to make money from a venture, from being an LP in a fund? 7, 8 years, 10 years, 12 years, 15 years?
Yeah, definitely not 7 or 8. You can start thinking about making money at year 10 in terms of actually closing the fund and all wrapped up, and you have the final, actual dollar amounts hitting your bank account. We're talking 15 years.
Those numbers all seem relevant today, but in 21, I mean, really 2015 to 21, I thought about these in 7-year sprints. I was like, oh, if you do anything over 7 years, you're an idiot. What are you doing? And today I'm like, no, like building a company obviously takes some time, but the funds themselves and just how they're deploying capital, that time horizon has just been truncated, and we just can't think in 10-15 years seems like a lifetime.
Insane.
It's basically the underlying shift in venture, and it has myriad impacts to how this ecosystem works. First and foremost, usually a fund is set up on a 10-year life cycle. And the reason why a lot of fund managers say we are going to be a 3x net fund, meaning we return 3x net our fees to LPs. That's like the baseline that all managers talk about. We're going to hit 3x and then maybe we'll be a 10x, but we're definitely going to hit 3x. 2 things on that. The 3x comes from the 10-year life cycle, because it's actually based on IRR that says this is the number we need to hit in order to outperform the public stock market on a
Yeah.
10-year basis.
What's the public stock market in 10 years? Like 2.3, 2.4x, something like
Something
that?
like that. I mean, lately it's been, if the QQQ
Yeah.
is higher than that, so that's to one side. The problem is if you promise 3x, but over 15 instead of 10 years, congrats, that's 50% less useful. So that's not enough anymore. And so there needs to, this is like, think of it like a pipe that's just been pressured so much. There have to be valves where you can mitigate some of that pressure. SPVs and secondaries are part of the solution set where companies or fund managers and particularly early employees and founders can take a little bit of cash off the table before the end of that 15-year journey, because
But
it's
they're not a
just
very big valve, though. Like, you have to have a lot of pressure releases. It's a little release here.
The thing is, and this is I don't think it's a dirty secret, I just think it's an obvious truth of venture. If we made every single venture-backed company available on the public stock market, 80% of them would never trade. They would have no float. There would be no demand.
There's nothing.
So yes, is it a tiny valve? Sure, but it's a tiny valve that if it actually looks a lot bigger if you're only focused on the segment of the market for whom any liquidity would be possible anyways. That's why if you look at these SPV counts or even secondary transactions, a huge percentage of the volume is concentrated in the quote unquote best names or the hottest names. Because most of the time, those are the people that actually have demand and the rest of startups don't. That's why it's so hard to raise around. You have to convince one VC to bet on you when the vast majority of them don't even want to look at your company most of the time. AI is like screwing with this a little bit in that there are some stories. I honestly haven't looked at this data within Carta, so I don't know whether I can prove or disprove it. But there are a lot of people talking about a Series A founder, for instance, taking $5, $6, $7 million off the table in a secondary during their Series A round, just because it was so hot and they had the demand. That to me feels like bubble behavior. That strikes me as very odd. Series A is not that far along in the in the life cycle of a company, and taking a ton of money off the table when you have it. I understand why you do it, but it does strike me as a weird sort of outcome of all this really concentrated demand.
Do you think the similarly to your point, I find that the existence of increasingly exotic financial instruments with opaque reporting requirements also tends to be indicative of a bubble, to the point of SPVs that own other SPVs that are layering management fees on top of one fairly passive investment. And to your point, it makes perfect sense that if you're an LP in to the point of 15 years, like, hey, this is a way to get cash back at a price that you feel good at. It feels more like a private equity kind of trade than a venture trade, because if you're a venture investor, you're trying to maximize the opportunity to get 100x every time you can. But nevertheless, that feels healthy. But the management fee stuff and that feels, and the $170 billion Anthropic valuation, and then like looking at the fundamentals all the way down, so that it really feels like if there's any pause in anything of flowing all the way up through the data center buildouts, or there's any insolvency that relates to the financing of these data center buildouts, that the whole thing collapses. Do you feel like we're in an AI bubble, Peter?
Absolutely. Hands down. And the weird part is when I'm asking people in SF, everyone agrees. They're like, yeah, it's probably a bubble. And then the next deal they do is at the wildest valuation and they can't wait to get into that hot name. It is really difficult for an entire asset class full of human beings to reject FOMO and to reject the bubble when there are some underlying dynamics that make more sense. So let's compare this bubble to the last bubble we had in 2021. Like on a revenue basis, the companies that are getting funded in this bubble are much better than the companies that got funded in the 2021 bubble. So on a multiples basis, it actually looks slightly less bubbly. But there is this sort of underlying, you peel back all the layers and you say, the Oracle thing that happened last week is a perfect example. Like OpenAI is going to give Oracle $300 billion of
That
data center
do not
money.
have.
They and not only do they not have, like it's an order of magnitude higher than what they have, and that shouldn't be their whole revenue, right? So like they're going to give it all to Oracle. Like there are deals like that where you look at it on its face and you say this doesn't really make that much financial sense. Either this time is different or it's not.
No,
And
I come. That's exactly the reason that I brought up that stack is because of that Oracle example. And
yeah,
I think me, AJ, and Asset all own Oracle, so we were very happy with that portfolio pop that happened last week. But
congrats.
nevertheless, to your point, you unpack it, and OpenAI is promising $300 billion that they currently don't have, that they will need to borrow to access, and their ability to borrow is predicated on growth rates that are that everything that's gone well to date has to continue going well, and then
Yep.
things will work out. But these bets have a history of not working out. And I was doing some research on the telecom space as a corollary, and it feels very similar, where there was, and it took till 2008 to 2009 from the fiber build out that happened
Yep.
in 1999 2000 for demand to finally meet supply. There was excess capacity in fiber optic cables for 10 years because of the overzealousness of the internet build out when everybody thought everything would be hard, broadband lines. And it feels very similar. I don't know if you feel that, Peter or AJ.
I think that the .com or the fiber build out is a good example of something where bubbles can be net positive to the general economy and population, just maybe on a long-term basis, but they can be incredibly negative to individual investors. And that's kind of how I'm thinking about today, where you say, if you compare it to .com, Amazon was a great bet. But for every Amazon, there were 80 to 90 other bets that looked kind of equally good that ended up being absolutely terrible investments. That's where we are right now. Like wherever you think is going to net out with OpenAI and Anthropic and others, there's clearly going to be generational winners from this boo, hands down. The question is what percent of companies that are being funded as though they're generational winners will actually turn out to be so? And my guess on that percentage is 5 to 10% max. So in that world, you got a lot of people funding companies at crazy high valuations that are going to be left holding the bag. I don't know when it's going to happen. I don't know how it's going to happen, but there's no part of me that says all of these valuations are actually totally reasonable and they're going to work out.
Well, the question that I have here is around collateral damage. So there's an AI bubble.
Yeah.
And when I hear people say that, it's like, well, I'm not going to be affected when the bubble pops feeling. And the reality is we're talking about a liquidity crunch, liquidity challenges. The bubble pops 12 months. There's thousands and thousands of companies that go under, but there's a handful that don't. What is the collateral damage to just tech overall and the tech ecosystem? And what does that look like?
Not good. I mean, pretty bad.
I mean, I guess the question really is the AI bubble different than like the tech bubble of 2000s? Or they're very similar where like, a SaaS company that's generating $15-20 million in revenue before AI, maybe they added AI and they've doubled that. Are they hurt in any real fundamental way, or is it just perception? I mean, I guess every company is different here, but like just thinking about this in the greater economy for tech.
I mean, perception begets reality, though, right? So
Right.
if a fundraising, super big fundraising decline, and again, when you strip out like the top 10 rounds from latest quarters, funding isn't, we're not back at 2021 levels of funding for the average
Right.
US startup. We're just way above it for certain specific.
That's the point, is it still feels like it doesn't feel great right now for a lot of people.
Yep.
It might feel great. So you strip that out
And you
it
look at
gets worse.
the economy is not great. We keep revising jobs downward.
Yep.
Unemployment seems to be ticking up. Inflation is still, there and
Interest
persistent.
rates.
And a lot of the stock market gains are predicated, they are being driven by whatever they're called now, the Mag 7, but they're driven by Nvidia and Meta, and AI is effectively supporting a lot of the public market equities gains. So I think it could be not good in the short term.
I think it could be not good too. And maybe, maybe this will be like a cold takes exposed podcast at some point, and then they'll look back and say like, these Luddites, like they didn't understand how AI was going to fundamentally change every part of the economy. I actually think you can believe both, that AI is fundamentally going to change most every part of the economy, and we can still be in a bubble. I don't think those two things are like necessarily in conflict with someone's rational worldview. And to your point, AJ, there's a lot of companies for whom this AI bubble hasn't resulted in a ton of funding for them anyways, right? They're like, I'm actually a great company growing super fast, and VCs won't even look at me because I'm not growing quite fast enough.
Right.
Maybe those companies kind of suffer through this pretty well as long as their capital structure, they haven't taken on too much capital externally and they don't need more capital to fund growth. This is maybe an odd statement. The part of the economy that I think would be most affected by a big tech downturn is actually the VCs themselves. I mean, the startups would get hit for sure, but like new VC funds already not nearly as many new VC funds lately. I think that if the AI bubble tanked, you would see just far fewer people that have the job title of VC.
So what's your advice? Let's wrap the show with a piece of advice for an entrepreneur that's trying to navigate this new world, understanding that there's all this volatility, there's winners and losers. They need AI in their, in the name of their company. They need to be AI native. What's a piece of advice you would give to an entrepreneur that's building a company right now?
The only way to navigate through this level of uncertainty, good and bad, we'll say unpredictability, is to know fundamentally that your business can survive without outside capital. You can raise as much money as you want, and that's okay. It sets expectations. You are working towards someone else's growth expectations, et cetera, et cetera. But raising money is not inherently bad. What is the problem is that if you raise on a plan, which is predicated on always having access to more capital, and then that capital goes away, you have failed as a founder because your business shuts down. So like, can you build a business such that your last fundraise could literally be the last dollars that you raised for your business and you would still make it out the other side? Default alive, I think, has never been more true. There are so many AI companies where you look into their hood. Well, there's two kinds. One is they're growing incredibly quickly. You look underneath the hood, they're burning money like there's no tomorrow. They're nowhere near profitable. There's another group that are growing slightly less quickly, usually, that are actually pretty like they don't necessarily need to raise. And you ask, why are you fundraising? And it's for all these non-monetary reasons. The brand, it's easier to attract engineers. We want to do X, Y, Z, etc. Some of it is we kind of just want some capital in the bank in case something goes wrong. All of those things are good ideas. But if your business absolutely needs to have constant infusions of outside capital, if there's a recession or there's a downturn, I mean, ask the companies that did this in 21, ask what their 2022, 2023 were like. It's really, really, really hard.
I mean, it is such a great point because if you're in the the podcastosphere for like VC and you're listening to all of the prominent people, they are not saying that, Peter. They are saying if you're not growing 10x, you're a loser.
Yep.
If you haven't built 15 agents to run your entire company, you're a loser. What are you doing, you loser? And it's all about losing.
This is every bubble, I think, has terminology that is kind of associated with that bubble. In the crypto bubble, it was have fun staying poor. It was something you heard all the time. Oh, you didn't invest in this in NFT, have fun staying poor. What you hear now is you have X months before you're part of the permanent underclass. That is like a statement that I hear all the time across X, which is if you're not making generational wealth in the next 12 months, good luck because you're literally going to be poor forever because that's what the AI AGI will take hold. Every one of these booms has this weird thing where people just get really, really super like aggro about, hey, if you're not 10xing every week, you are completely screwed for your whole life. And that's no fun for anyone. Don't be those people.
AJ, what's your advice?
I'm just sitting here trying to take it all in. I'm going to stay off X because I don't want to be called a loser. Also, Sam, talking to you, Sam has this very Sam's like, everyone, you're a loser. Cash is king. I think Peter said it very, very well. And don't run out of capital. It's like the number one rule of entrepreneurship and founding companies. I love the idea. If you raised a big round, then it's okay to like have a plan, have a real long-term plan with that.
Right. I'm going to agree, but I'm going to say one last thing. which runs counter. It depends how much capital you need to do what I'm about to say, which is, I agree. Peter made the point earlier that things are happening on a compressed time scale. Stuff that used to take 5 years is taking 2 years. Stuff that used to take 10 years taking 5 years. We talk a lot, and AJ talks about how QuotaPath is extendable, adaptable, flexible, meaning it's got APIs. It can hook up to anything and unhook from anything very, very quickly. And I think one of the things that is compressed is the LTV of recurring revenue businesses. So I don't think it's a pricing. I do hear some entrepreneurs talking about their primary innovation being a pricing model change. But I think you cannot run out of money, but you have to find a way to innovate efficiently, because I think that relying on your recurring revenue base in the absence of innovation, I think recurring revenue can disappear more quickly today than it has ever disappeared before. And anything with any meaningful amount of churn, and you're expecting some kind of revenue multiple on it, and you can't even, if you've moved from a revenue multiple to an EBITDA multiple, but you've got meaningful churn, you look at that EBITDA, you can't even count on that. And so you really have to be thinking about, how do I continue to innovate and deliver better and better experiences to my customers, all within the guise of efficiency and profitability, which is obviously a very high bar to execute. But I think it's really important, because I think everything is less sticky today than it used to be. And people can shift off platforms very quickly.
Sam, that's a fantastic point. I'm going to add to it as well and say distribution, and that we should be all thinking about our distribution models. I mean, that stickiness factor, I think, is 10x when you have a network effect or partnerships or community from a pavilion standpoint. I know Carta has done a really great job in just creating a phenomenal network effect within its ecosystem. And I think that that's something that we should also be thinking about. So it's easy. Cash, innovate, and distribution. Just do that and you're going to win.
And we're definitely in a bubble.
Just go ahead and win. Why don't you?
Stop being a loser and decide to win.
Have fun staying poor. Decide.
We're all members of the permanent underclass. It's very
ridiculous.
Peter, thanks so much for being on the show. We can't wait to unveil you publicly as a member of the Top Line Contributor Network. Maybe we'll see you in Cancun for reasons previously discussed. And we'll talk to you soon. AJ, great seeing you.
Thanks, Sam.
The honor is mine, guys.
Thanks,
Peter.